Welcome to the third episode of ConnectCTNY podcast. We're live at the Ridges in Stamford, Connecticut, the host of our next event on May 18th. I'm Mike Spindler, sitting next to my co-host, Austin Glazer. What's up, man?
I'm here, but I'm more excited about our guest that's joining us today.
Me too.
We're joined today by Manny Gomes, a guaranteed rate mortgage. And Manny, how you doing?
I'm doing great. Absolutely great. Yeah, flew in last night here.
Yeah?
Awesome.
Easy flight?
No. We flew into a storm. We circled around, had to be reverted, landed, stayed on the plane for a couple hours, then flew into JFK. Then I got a flat tire on the way home. But I'm here because that's how important you guys are.
That's dedication.
That's
right
dedication
there.
to the craft.
That's dedication.
Oh, I love that. Well, Manny, tell us about yourself.
Well, I'm a mortgage guy. That's what I do.
Not just a mortgage guy. One of the best.
Okay.
One of the best.
I am talented in this arena,
right?
But that's just because I've been doing it for a long time. I got into this in 2008 when everyone was telling me it's the worst time in the world to get into the mortgage business because that's when everything was crashing. But I remember a professor told me once that you want to get into a profession where people are exiting so you can enter and learn the right way, right? Because when things are really good, you don't learn things the right way,
Right.
Sure.
right? You just become used to the easy grinding work and not the deep, hard grinding work, like becoming a student of your craft and learning it inside and out. And when I got into it, I had to get really, really good in order to get business because all the, I like to call them dummy loan officers, they left and went to sell cars and other things. And I think the same thing is happening right now because the mortgage market has been contracting.
Did they become realtors?
No, not
good.
I
We have
don't know.
What's happening right
We have
now?
enough of those.
Yeah, realtors are also exiting as well
Right.
because they're realizing how hard it is to be
Yeah.
a realtor in a normal market, not an explosive market.
Right.
You know,
Sure.
anyone can sell anything in an explosive market,
Yep.
but how to sell a property and transact the transaction correctly in a normal market or even in a soft market, that takes some real skill. And those are the realtors that can do well. And those are the loan officers and insurance people that will do well in the next few years.
Yep.
Are those that are really a student of their craft and continually learning and improving. And that's what I started doing in 2008, and I do it to this day. And that's what I think sets me apart is I'm always learning. I'm always trying to figure out how to put a borrower in the best position through a loan program or just giving them some general kind of financial advice that is like kind of most people think is normal, but most people have their blind side. They have their blind side. They don't look at things. And it takes somebody else with a different perspective to expose them to different ideas that makes them have that aha moment.
Yeah.
Kind of like the last 2 years when interest rates were really low. I had, the first-time home buyer who had the normal first-time home buyer mentality. Like, hey, I'm going to buy something small and move up in the next 3 or 4 years. But we're not in a normal first-time home buyer market.
Definitely not.
Right? The normal first-time home buyer now is like in their mid-30s. Not their mid-20s.
Sure.
Right? They're at a different level of their income. You make a lot more money in your mid-30s if you've been in your profession for a decade plus than you would in your mid-20s. But they were coming to the housing market with the mindset of a first-time home buyer in their mid-20s. So what I found was happening throughout the years was I would have buyers coming back to me like 2 years later, 3 years later, like, hey, we want to buy, house was too small. We have 2 kids now, right? Because they're older. So they're like, all right, we don't have that much time to make our family. So they kind of have kids back to back. And then they'll be buying another house. And at one point I sat down and did the math. I'm like, all right, someone spent money on closing costs, realtor fees, and then again on closing costs, buying their house and attorney fees again. And they originally were trying to save themselves like $400 or $500 in monthly payment 2 or 3 years ago. So I ran the math and it was costing them more money to buy a property and then sell it 2 or 3 years later than they would have if they just bought the right home.
Ooh, so that's interesting. So I'm cutting you off to ask you a follow-up. So when that would happen to you and you'd have a buyer come to you and they would say, we want to spend $600,000 for our house, but you realize that, they probably wanted to spend $7,000, were you kind of coaching them in the direction of, hey, this makes more sense to buy this because you're going to come back to me in 2 years and say this, and it's going to cost you more money now versus than it would then? Is that kind of what you were doing?
I was trying to illustrate to them the opportunity cost of their decision.
That's very interesting.
So I would run the math. I'm like, all right, so why are you trying to be at this price range? And of course, I take a look at their income. If it looks like they're way overqualified, then I'm like, all right, you're not buying probably right. And oftentimes I have all their information on my application. Like this is the part where I become quasi, financial therapist versus like just a mortgage guy. If I see that they have little kids And I asked them, like, oh, are you planning on having more kids? They're like, well, yeah, probably one more. And I'm like, all right, do you think this property may be a little small for you? They're like, well, yeah, but it's our first house. We don't want to keep our payment at this level, right? And it's always psychological, right? If somebody wants to keep their payment under 3,000, right, or under 2,500, or under 2,000, then I asked them, like, why? They're like, oh, just what we're comfortable with. It has nothing to do with their finances. It's all a psychological number. Because if you go over 3,000 to 3,100, like, oh, it's too much. I'm like, all right, how much do you spend on Starbucks a month? And then they're like, probably over 100. I'm like, all right, make coffee at home, buy the house you want, right? It's Starbucks money,
right?
You know, I started saying that to people to put it in perspective, right? If you're going up to $200, but it's going to get you the house you really need and wants, you figure out ways to shave off in other areas, because your home is a primary investment. It's where you can be living. You don't want to make a mistake buying the wrong home. That becomes a very expensive mistake.
Well, I mean, now, like, so from the perspective of, like, say they didn't listen to you and they bought that cheaper home, 3 years ago, and now they're like, okay, Manny, we're ready to buy that house. Well, now that rate is probably doubled versus what they were going to buy it for, and they're upside down. So with that being said, what's going on with the rates? Like, what's up? Like, where are we at?
Let's put it into perspective. During that time period when rates were coming down, and borrowers would come to me, he's like, hey, do you think they're going to come any lower? And I'm like, well, I can't say never again, because at one point when rates were in the like high threes, I told borrowers like, hey, I probably will never really refinance you again. And then rates dropped into high twos. I'm like, oh, I guess I'm eating my words right there. So I can never say never again, but it took a global pandemic and a massive amount of stimulus money from the government to bring rates into the high twos, low threes, right? That's not happening this time around. The government messed up. They created a lot of inflation, and now I think they're getting the handle on inflation. We're starting to see some of the components within the inflation metrics start coming down. Not everyone will agree, but like most things have stopped going up, right? So that's the first step towards controlling inflation, is preventing it from moving any higher. And from there, consumers typically will cut back once they see how expensive things are from a financing perspective. Sure. Creditors will then feel less willing to lend when they perceive risk. So there would just be a lot less money circulating around the economy.
Right.
And it's a lagging effect. And where I think we're probably at the point where the Feds, which are actually kind of meeting this week, will probably signal to the market that they're going to stop hiking the short-term rates. Right. And once that happens, the bond market is always smarter than the financial markets. And once the bond market feels that the Feds are within 6 months or so of cutting rates, they're going to get ahead of it, and bond dealers will start building positions. And this will help rates come down before the Feds actually cut rates. Same thing happened when rates were going higher last year. Well, before the Feds actually increased rates, mortgage rates already went up 2 percentage points before the Feds increased it once.
Yeah.
Right, the short-term rates. So the same thing will probably happen this time around. And I do think we've already peaked in terms of rates. We're likely going to head to the low fives, high fours. And that'll probably be the happy place for rates for a little bit of time. Because if you think about it, mortgage rates can't be much lower than the rate of inflation or much higher than the rate of inflation. And the rate of inflation went as high as 10%. So mortgage rates were really low in comparison to inflation at one point. Now inflation expectations are to be around 6 or 7%. So if we get to high fours or so, that'll probably be the happy place for rates. Now, really, I want to make this point clear. People who are waiting for rates to get back into the threes before they choose to buy, they may be waiting for a very, very long time. Those things happen once every, economic cycle.
Yeah.
Well, and I'll just add to that. Even if they wait to get into, like, let's say it gets to the mid fours, I think that's an issue, because now all of a sudden all the buyers are going to come back into the marketplace. Everyone's going to have that same idea, or a lot of people are going to have that same idea, causing the prices to continue to go up. You're going to have bidding wars. So, like, yeah, all right, maybe it's 6% now, but maybe there's only 6 offers on the table and not 12 when the rate goes back down. So those people that are waiting makes me very nervous if you're waiting for that specific reason.
Yeah, correct. And one thing I believe people make decisions on, especially when buying a home, is what they believe will happen in the future.
Right.
All right. So if we kind of take a look at the current landscape, right, we have creditors who are under trouble right now. First Republic Bank just got taken over the weekend by the government. So now JP Morgan Chase is likely going to be taking over it. This is the third largest, the third large lender who has been taken over in the last, month and a half or so. Right? So other regional banks are looking at their portfolio. I'm like, hey, are we in trouble as well? And they're going to probably kind of redefine their lending practices going forward, redefine their risk practices going forward, and that's going to make it harder for people to actually get loans. But then they have the loans that in their books that are at low interest rates are written in the last couple of years.
Right.
What are they going to do with that?
Right.
They can't sell it. Nobody wants those loans.
Right.
They're going to be working with their borrowers, restructuring it as much as needed so that people can stay in their car or stay in their home. So we're not going to see a flood of inventory from the banks hit the market. Right. For the first time ever, creditors are actually working with people on their car loans.
Yeah.
Which is weird. Like they never did that. The repo guy will show up, take your car.
Yeah.
But they don't want that. Like it's a depreciating asset at the moment,
Yep.
right? Yeah, it went up too high, and now if they don't want to flood the market
Sure.
with auto vehicles because they know that they'll just exacerbate the problem. Same thing happened in 2008 with the housing. The banks took over. They went through their normal protocol. All right, foreclosure, dumped all of this inventory on the market, and it just collapsed the price of housing, which made it much worse for the banks. Right? They've learned their lesson from that, and they're like taking their lessons from there, and they're spreading it out into other areas. Like I guarantee you, personal loans they'll be reworked. The car loans they'll work with the borrower, especially if the rates are low, because nobody wants to buy that paper.
Sure.
It's worthless. If you could get a rate of 8% and you're going to take over a portfolio of loans at like 3%, nobody wants it at all.
See, one of the reasons why you like that, just to find out, one of the reasons why I send my clients to Manny, because he has his, I think two things. One, he has his finger on the trigger of the economic landscape, which, yeah, some mortgage brokers, whatever, but like he knows the ins and outs better than anybody. And then second to that is I think he asks great questions, which ultimately helps me in my job, right? Because part of the sales process for all of us is asking great questions to get them in a better loan, get them in a better insurance rate, to get them in a better house or whatever the case may be. So I think because of those two things, I think make you very good at your job because of those two things. I'm curious, talking about the rates and kind of credit scores and things like that. I'm curious on the new law that just passed with the borrowers who have a very good credit score kind of getting penalized and kind of all that stuff. I'm curious on your take on that.
Yeah, that's a hot topic at the moment.
Very hot topic.
And so it's one of those things that at one point I only talk about politics, religion with clients. And now I'm feeling like this is entering the political area, right?
Definitely hovering around that for sure.
Yeah.
So politicians always want to do what's best for everybody, and they especially want to serve the underserved, right? And this situation is people with lower FICO scores, right? If you look at any stats, individuals with lower FICO scores tend to be renters versus owners. And that's just the economics of things, right? If they have not showed credit worthiness, why would a lender offer them a loan, right? But Fannie Mae and Freddie Mac are run and controlled by the government, so they could redefine risk on their own. But in terms of what they've done here is they are taking the smallest percentage of loans that they originate at the lower FICO scores, especially for Fannie Mae, Freddie Mac. Let's forget FHA for here. And that's probably like 15 to 20% of all the loans they originate. And they're making those rates better for the consumer, thinking that will magically help somebody buy a house. It won't. But these are politicians, and they want to make different people happy. So now
so it's more of the idea of it than anything else.
They believe it will help because don't forget they get this data and they're like, oh, how can we help these people? Like, oh, they can't get loans because of their credit, right? It's not just their credit scores or the rates, but it's their overall credit worthiness. So they're like, oh, let's make their rates lower, and that should help them increase their purchasing power.
Sure.
In theory, it works, but then you apply it on paper. Well, paper is the theory is the same thing, but then you put it into practice and it falls apart because there's going to be a higher default rate on those loans. There always will be for them. If anyone has a FICO score south of 650, that's what the FICO score is calibrated to calculate. What are the odds of somebody going 120 lates on an account? That is what the FICO score calculates. The higher your FICO score, the lower the odds of you falling behind on payments.
Right.
The lower the FICO score, the higher the odds of somebody falling behind on payments. Very simple, right? So now what the government's doing is they're removing the risk from the lender and saying, hey, we'll still buy these loans at a premium price at lower FICO scores, so you can offer this clientele's lower FICO scores, right? So that's how they're doing it. But it's at the sacrifice of the other side of the spectrum, the 80% of people that normally get their loans and should have lower rates, they're the ones paying for that small quantity of individuals. And, if you look at our tax code and everything, it's all kind of the same. When you get into politics, it's kind of what tends to happen. But it's already been kind of massaged into the system. 2 or 3 months from now, people probably won't even be talking about this because it's just
a hot button news topic of the day.
Yeah.
So you don't see it with a major impact on the market?
Well, no, because I think rates in general are going to be heading lower.
Right.
So
So
it's
it
just
kind
going
of
to kind of
balances
negate
out
that.
anyways.
Right?
Yeah.
And we'll find out if this is going to hold. I think that with enough kind of pushback within the year, they'll probably reverse some of this.
Yeah. All right, so here's the final question. Is obviously the ConnectCT world is about networking, business owners, entrepreneurs, bringing them all together. So I guess the question is for you is what industries are you looking to connect with to help grow your business?
Well, it's like I've built a referral-based business.
Sure.
So, great agents that want a great loan officer. Right now I've been saying that, whenever the economy starts turning, divorce attorneys are the best referral sources.
Yeah.
They need someone to refinance somebody out of it or list the house for the parties that are getting divorced. So, good divorce attorneys will be an amazing connection. But pretty much, that builders, it's really just quality people who are a student of the craft. Really, that's who I love to work with. And that's why I love working with the two of you, because you really are invested not just in your business, but continually improving in your business. And that's
Appreciate that,
what
man.
anyone who's looking to hire a realtor, an insurance person, anyone, that's what they should be looking for. Not just someone who just calls and answers the phone. That's important.
Yeah.
But it's someone who's continually learning and improving, because they will do more for the clients and they'll be able to look out for their blind sides better than anyone else.
Yep. That was a great answer. So how's the best way if people want to connect with you, what's the best way? Website, email? Yeah, where can they find you?
Yeah, I'm highly Googleable. Is that a word, Googleable?
Googleable.
Yeah, Googleable.
That's good.
All you have to do is, Manny Gomes in Google, my website will pop up.
You do have a lot of
contact
Zillow
information.
reviews too.
Yeah, Zillow,
That's solid.
Google reviews, Facebook reviews. There's been a collection that piled up over time.
Right.
Just Google.
Yeah,
Yeah.
just Google.
Yep, Manny Gomes Mortgage. I'm there.
All right.
My Instagram.
Manny, thanks for coming. Let's raise a glass and say cheers. huh?
Cheers, man.
Cheers.
Thanks for being
Hey,
on.
guys. Let's do it.
Thanks for having me.
Great job.
Yep.